And as I mentioned in the emerging markets forecast, if you only care about the US markets, make sure and watch the emerging markets forecast as well, because I include economics there that I may not include in this presentation. And it also gives you a sense of what's going on in the big picture, because everything is relative. Keep that in mind. It's easy to understand that currency strength and weakness, currency health, right? Currency performance, foreign currency is relative, right? It's all relative to other currencies, right? Just like to some extent, to some degree, commodities as well. But also foreign capital markets. All capital markets are relative, right? A good example of the foreign currency situation, of course, is the US dollar. One reason why the US dollar continues its very strong bullish trend is because all these currencies are collapsing. Why? Everyone is going to US dollar denominated assets. Why? Because once again, and folks, this is not just a recent phenomenon. Every single competent, experienced Wall Street professional will tell you the US capital markets have for a very, very long period, many decades, I don't know exactly when, have been the best assets to be in. That's why the US capital markets are the largest in the world. They have the most transparency. They come under the most scrutiny. They're the safest investments to be in. And when things get challenging, even when a period in the US when things get challenging and it looks bad, maybe investors will shy away from US dollar denominated assets in the beginning, right? Like they did during the financial crisis, but that's short term, because what affects America is going to affect the rest of the world pretty quickly too. And when it affects the rest of the world, the investors come back into dollar denominated assets and they stay there. That's why we saw during the Standard & Poor's downgrade of U.S. sovereign debt, U.S. government debt in early August 2011, we saw what? Well, we saw a short problem, very quick, and then what happened? Everybody flooded into U.S. dollar denominated assets. The rest of the globe was in a problem, right? So keep that in mind. Okay, keep that in mind. It's very important. Let me begin by discussing some big picture points. Over the past 1 to 2 years, the winners of the global economy, if we can even have a designation, have been the US, the UK, and Japan. Right now, the US has been strong on a relative basis, relative to other economies, for the past several years. Right? I'm not going to go into the structural problems in the US. I'm not going to go into the fact that the US stock market no longer serves as a barometer of the health of the US economy. I've talked about that in the past. There's no doubt about that. But the fact is that with respect to investments, the capital markets, earnings, and somewhat superficial and somewhat more substantive economics, the winners in the global economy in terms of major nations have been the US, the UK, and Japan. Now, Japan, of course, they had their upswing shortly after the quantitative easing program. More recently, during stage 2 of their restructuring process, stage 2 of 3 stages, they experienced a problem because of the VAT tax, value added tax. Complete disastrous situation. Why a government that understands the psyche of the Japanese people who have endured 2 decades of deflation, very spendthrift individuals in Japan, why this government would try to raise tax revenues by increasing the consumption tax, I have no idea. Complete foolish situation. Now, I didn't think it would be as disastrous as it was, but I certainly didn't think it was a good idea. And the shocking thing is that the Japanese government, Prime Minister Abe, has the option to raise it again by another percentage point through, I think, October 2015, which is a possibility. They're actually thinking about this. Complete disaster. The last thing you want to do is raise the incentive to not spend for people who have experienced deflation for 2 decades. There are people in Japan who don't know anything other than the deflationary period, right? The younger consumers. So they're very, very frugal. Why would you want to raise the consumption tax during an economic slowdown, a global economic slowdown? The economy's not doing that great. There's other ways to raise those revenues, okay? And the VAT is not a good way, especially in Japan. That's for certain. Because think about it. We're talking about a global force of deflation that's increasing It's not substantial, but it's accumulating. It's gradual. It's encompassing more nations now. The worst thing you want to do is provide a disincentive for spending, right? Bottom line is, as a result of that value-added tax boost, and that's the first time Japan has had a boost in their value-added tax in, I believe, 2 decades or so. But anyway, Japan has weakened since that time, and of course, as a reaction, as a response, as a resolution to that problem in the economy, the slowdown, the Japanese central bank, the Bank of Japan, recently announced a boost in their quantitative easing, which, of course, as anyone could have predicted, would cause a sell-off in the yen. Okay, and as I've discussed recently over the past few months, if you are a currency trader and you're not making boatloads of money trading currencies over the past few months, then you probably should consider discontinuing your trading activities for the foreseeable future in currency, because this has been the easiest currency profits I think that I've seen in many, many years. For instance, the euro, right? We talked about the downside of the euro. Once they acknowledged deflation in the spring of 2014, clearly the currency was going to weaken. Once they announced the asset purchase program, which I have been forecasting for the good part of a year now, that's obviously going to put downward pressure on the euro, right? And of course, same thing with the yen, right? And there's going to be short rallies and so forth, but we're still looking at a longer term trend of downside. So we're looking at a downward trend for the yen, for the euro, for many of these currencies. Anyway, so the UK economy has been strong over the past, let's say, 14 to 16 months, and that's been somewhat of a surprise to many individuals. I don't think that's going to last. I think it's going to be taken down by the weakness in Europe because of the strong trade relationship. However, I think there's also some mumbo jumbo, smoke and mirrors going on. I don't think the economy, even aside from the problems in Europe, is that strong. I think it's being boosted by kind of accounting shuffle, if you could say that. I just don't think you've got real strength there. Also, of course, the German economy has held up over the past few years, but as we forecast back in our 2012 mid-year global economic analysis report, that big, huge report that everyone should have, we talked about how Germany and France will be taken down eventually by the weakness of the euro, of the European Union, and this is what's happened in Germany. And of course, recently Germany reported some really worrisome economic data. If in fact you focus on monthly data, we don't focus on monthly data except for a trading opportunity, but we're looking at trends. And obviously the German economy has trended downward, but the recent data from last month, this is what part spooked the markets. Of course, the German economy since then has released some more upbeat data, but nonetheless, Germany is not going to escape the quicksand of the European Union as long as they remain in that disastrous situation. Now, China, of course, has been a bit weak, but the growth hasn't come down substantially, that is, yet, right? So we need to keep that in mind. As weak as the emerging markets, the developing markets have been, they're still pretty strong. But investors look at momentum, they look at acceleration and deceleration, right? Because that's what earnings are all about. So from that perspective, it's not looking that good. But still, it's not looking terrible. It's just that we have this big risk in China. Of course, the other major emerging market or BRICS economy is Russia, which of course is in a free fall. One could argue they're kind of in a depression. I don't see the Russian economy improving from an upward trend standpoint for quite some time. Of course, it's pretty obvious. And obviously, the lower oil prices are adding insult to injury for Russia. Now, Brazil, of course, and Italy are in the dumps. We don't see any real signs of light in these two nations in 2015. There could be some modest improvements, but I don't think we're going to have enough improvements to signal a definitive upside in the trend of that economic data. Depends upon how things go. Depends upon any potential economic stimulus. I don't think really either of those nations are in good situation to really add stimulus, but we'll have to see what they do. And then finally, of course, Australia, which anytime we think about China, we're thinking about Australia. And that's the way investors should think who are interested in Australia, the Australian investors there. As goes China, will go Australia. And Australia, of course, has been able to avoid a recession for nearly 25 years. And I think it's largely because of China. So I'll get back to Australia in a minute. I don't want to distract from some of the other things I want to mention about some of these other countries. But Germany, for instance, once again, the October data for Germany was positive, but we feel it's going to weaken further. And I mentioned this last time. One of the bright spots in Europe has been Spain, right? They reported some pretty good upbeat economic data over the past few months. I just don't think that's going to persist as a trend. I think it's pretty obvious. Despite the sell-off, the collapse in the Spanish real estate market, I think there's still a little more downside. And of course, you've got corporate debt in Spain. It's very high. So given this perspective, this look at these major economies, if we look at everything, if we look at the largest economies in the world that comprise the largest components of global GDP, we can see that the weakness in Japan, the weakness in Germany, that's combined. So if you look at that picture relative to a few months ago, that's not encouraging. Why? Well, China, we haven't seen much of a declining trend there, but Japan over the past few months, there's some problems, right? Germany, some problems, right? France has been in the dumps. France is not going anywhere but down. In the UK, things have been boosted because of the UK. I don't think that's going to last. I think a lot of that's smoke and mirrors. Brazil, not getting any better, but getting worse, as a matter of fact, right? Italy, not getting any better. Large risks out there. Russia continues to get worse by the day. India has been a bright spot, but that's been kind of priced in to the economic forecast earnings for several months now. Canada, not doing that well, not doing terrible, but there is still more downside risk because they're tied into the commodities market, right? And especially the oil. You can imagine the lower oil prices is not helping the Canadian oil industry. Australia has, it's showing some problems, right? But they're still relatively strong. I think that is a delayed effect. Australia has, I think, a considerable amount of down. And you can imagine, as I've discussed in the past, the mining boom is over. Australia now has been scrambling to see what they can do to replace that, right? They know the mining boom is over. I've even heard about the talks in Australia about, what can we do to boost our tourism industry, right? Because, of course, the Aussie dollar has taken a pounding. And by the way, I think the Aussie dollar is going lower. I think it's still excessively valued. I think that the Aussie dollar, without a blowout in China, could fall by another